the first quarter was very strong, in part due to a recovery of the price of oil and a recovery in a number of the energy bonds that traded off so badly in the fourth quarter. The loan market has given a surprisingly straight line return all year until very recent weeks with the problems around Greece. We also looked at defaults and expected that defaults would remain quite moderate in the 1% to 2%, maybe a little bit higher range over the next 24 months. Energy is approximately 15% of the U.S. high-yield market, about 4% of the U.S. loan market, and very tiny exposure in Europe. In U.S. high yield, this had a very large impact in the fourth quarter of 2014. But interestingly enough, energy recovered quite strongly in the first quarter of 2015, in part because of a recovery in the price, though still well below levels at which these companies can actually make a profit. And I'm thinking now of the drillers and the E&P companies that are primarily focused in the shale area, which is a pretty big chunk of that 15%. And we've seen quite a lot of volatility in the second quarter around the energy companies. In the loan market, the effect has been a little bit more severe. A lot of these companies are the drillers, which are quite a bit more exposed than just the E&P companies. But it's such a small percentage of the loan market that even though the returns for energy, especially in the last month to 6 weeks, have been fairly bad in U.S. loans, the overall effect on the loan market is quite muted. We expect the volatility to continue, certainly until there's some more certainty around what's happening with Greece, which we think will last another month at least. We're going to see volatility. There's going to be volatility around the signals given by the Fed and when the Fed actually starts to change policy. Our markets have been relatively quite resilient. We've had lower volatility than some other markets. We've seen rather muted responses to the daily headlines. And actually, we've seen assets continue to be attracted to the market. Issuance, which was quite muted in the first month or two of this year, has picked up substantially. We have had very strong high-yield issuance, kind of at the same pace as last year. And the last few years have been actually all record issuance years for high yield. And in the loan market, we've seen issuance pick up, kind of a catch-up from what we had in the first, let's call it 4 or 6 weeks of the year. And the loan market issuance has done quite well, both in the US and Europe. So we actually feel reasonably positive about the markets and their resiliency. Well, we have two historical data points to draw from, and those are the Fed tightening cycles of 1994 and 2005. In 1994, the Fed started raising rates abruptly and rapidly across 1994. High yield did poorly at first across the board. But then we saw a separation in performance between double Bs and single Bs and triple Cs. Triple Cs underperformed double Bs and single Bs. Now, to be sure, the whole market performed poorly for the year. Double Bs and single Bs eked out a positive return, though well below coupon. Triple Cs, however, had a far worse performance, returning almost negative 10% for the year. This is not because of the change in the shape of the curve, but really because the Fed, as they're draining liquidity from the market, have the biggest effect on the weakest companies in the market, namely the triple Cs, the ones most exposed to refinancing risk and default risk. The Fed started in June of 2004, but we didn't really see an effect until we started in 2005. But a similar thing happened. At first, the market traded off across the board, and then we saw the similar separation. Double Bs and single Bs outperformed, got a positive return for the year, still below coupon. Triple Cs performed worse, not as badly as they had in 1994, but still getting a negative return for the year. We thought that we would see something akin to 2005 as the Fed starts raising rates. However, the Fed has been very clear that they will raise rates, so-called data dependent, that is, at a much slower pace than they had in either of the past two cycles. So the effect may, in fact, be quite muted.